Welcome to our series of recap videos and to our introduction to accounting course. Welcome back once again. Let us look at the investing activities of the cash flow statement. And this segment is pretty much simple. What it does actually is that it looks at the investments in long-term assets that the business has made and the impact on cash. So if we buy any property, plant and equipment, which we call PPE, we straight away account for the cash here, deduct it. If we make any sale of the property, plant and equipment and we make some cash, it's also accounted for here in the cash flow. So it's pretty much simple. If we purchase any goodwill by any business acquisitions thereof, we also pay out some cash and it's accounted for here. If we buy any intangible assets like license to operate under software and all of that, which are used over a period, over a year, then we account for the cash movement in the investing activities of the cash flow. Almost always you find this balance being negative because we are likely to be buying more of assets, that's long-term assets, than selling them in order to get a positive cash flow. Unless we have some long-term investments like investments in bonds, investment in other businesses, and the rest, which will be here, the release of which will give us so much cash to overturn the likely negative balance here into a positive. We are almost always going to find this balance being a negative because we are almost always going to buy assets, long-term assets, than sell them. So this really looks at the long-term assets of the balance sheet. So this section, long-term assets of the balance sheet. Remember, the operating activity section looked at the current assets, current liability section of the balance sheet, and the investing activities are also looking at the long-term asset section of the balance sheet. So technically, all the asset section of the balance sheet has been taken care of, either by the working capital, which is taking care of the current asset, current liabilities, or the investment activities, which is taking care of the long-term asset movement of the balance sheet. Now, what remains really is the long-term liabilities section of the balance sheet. And the long-term liability section of the balance sheet is adjusted for by the financing activities of the cash flow statement. And that is why we said that the cash flow statement is like a reconciliatory statement. It looks at the movement of cash between the income statement and balance sheet. So it picks every line and adjusts for the movement. Everything in the income statement is accounted for at the net income line in the operating activities. And then you make your adjustment for your notional charges I've already explained. Then the current asset, current liability section is looked out for in the working capital line. The investment activities is looked out for by the long-term asset section of the balance sheet. And then the financing activity section looks at everything in the long-term liability section of the balance sheet. So it picks the revolver issuance and repayment, that is this line, and then it also adjusts for any variable debt issuances. So any debt issuances which the interest rate will reset over a period of time, and I've explained this in the balance sheet section. If you need a recap, refer to our earlier video on the balance sheet. the fixed issuance or repayment. So you either issue more debt, that is, you take on more debt, either fixed or variable, or you repay your debt, you redeem your debt, or you issue preferred shares, or you buy back your preferred shares. So if you issue, you get cash. If you buy back, you lose cash. Or you issue more common shares, or you buy it back. So it's the same principle. You issue, you get more cash. You buy back, you lose cash. Or you pay preference share dividend, which is definitely going to be a cash outflow. And your common share dividend you pay, which is also going to be a cash outflow. So if you look at it, really, it's very, very straightforward and simple. The financing activities looks at anything financing. So you look at your debt finance, your revolver, that is your overdraft financing. As you make cash, you pay it off, and the rest. Your variable debt issuance, that, or your loans, your fixed debt issuance. So these are pretty much the same, either being variable or debt is pretty much the same. Then preference share, that equity issues, preferred share issuance, buyback, common share issuance, and buyback. And then your dividend payment, really. So if you look at it, this side is also broken down into like a 3 level. You look out for your debt sessions, okay, which is your revolver, your variable debt, your fixed debt, and then your equity session, which is either preferred shares or common shares, and then the dividends thereof. So debt, these 3, your equity issuances and buybacks, these 2, and then the dividend payments thereof of the equity. The debt rewards, which are the interest, have been adjusted for in the income statement as an interest expense line. So you are not going to have their payment to their rewards being part of this. It's a long-standing debate. Some people feel that dividend payments are an operating activity. Some people feel it's a financing activity. But that is for those who are taking accounting to a higher level to decode. But for us as modelers, we only need to know that we are looking out for our debt financing, our equity financing, and then the dividends to the equity financing payment. And we are through with the financing activity session of the cash flow. So the sum of all of these will give us the financing cash flow of the business. And then you pick your opening cash balance as you started the year with, and which is this line, the opening cash balance. That's the beginning cash balance as you started the year with. The adjustment between, so the change in cash position is the sum of all the financing activities, the investing activities, and the operating activities. So the movement between everything financing, everything investing, everything operating, that is what will give us this change in cash position for the period. You add that to your beginning balance and you get your ending balance cash flow of the business. So to sum it all, we are saying that the cash flow statement looks at how money is made and how money is spent. So we make money from our operating activities. That is our main main revenue producing activities of the business. We make money from investments here, and then we can also get money from financing, other people financing our business externally. So you can also see, and the balance of it becoming our changes in cash position, we add it to the cash we already have beginning the period, and then we'll get our cash we have generated at the end of the period. So this brings us to the end of the cash flow statement section. What we are going to do next is that we are going to see how these statements link together, the linkages. I've just done the explanation to the lines, and we are going to look at the linkages. I hope you go along with me to the next sessions of the video. Thanks for staying through to the end.